Dan Hunt with Redhawk Investment Advisors, and I'm here to attempt to put into perspective some of the information that Mr. Jeff White has been sharing with you over the last several lessons. He's been talking about things like puts and calls and premiums and selling junk or selling time. He's talked about intrinsic values, extrinsic values, all kinds of basic options trading strategies, but to many of you it still may sound like a foreign language. And so what I'm going to do today is summarize some of the information and put it into perspective so that you are able to explain to your clients a little better what you are doing for them. You will also have a better feeling as it relates to the safety of your clients' assets. And for those assets they do choose to put at risk, you're going to understand and be able to articulate how they can be managed in such a way that they can provide more value. This service, this options trading service, can provide more value than any of their other options on the planet. And now everyone on the planet wants to know historical returns. They all want to know historically, 3 years, 5 years, 10 years, how a particular investment type has been performing before making their decision on whether to buy this investment or not. I personally think this form of decision making is not as productive as designing your risk and reward potential going forward in time. So in reality, we find that many of the products and services we do sell today, such as equity index annuities, really do the very same thing. When we go out and we find insurance companies who will cap the upside return potential in favor of never allowing that client to lose money. They cap the downside to say 0% return, worst case. Now what if you were able to take that sort of advantage, that equity indexing advantage, as the baseline, sort of the foundation of the house, and you were able to build on that, you were able to put an overlay on top of that that would take those clients' assets that they do want to put at risk and allow them to do the very same thing the insurance companies do, but with much higher return potential over a much shorter period of time and much higher liquidity. Attention to the board behind me. I'm going to show you a little graph here that represents 3 different investment opportunities, and see if you can guess what they are. The first one is flat. In other words, it gives a fixed rate of return over a long period of time. What kind of investments might that represent? Yeah, you probably guessed it. You've got CDs, you've got money markets, you've got bonds, all kinds of things like that. So that was relatively easy. The next one looks sort of like a stair-stepping model where it may follow a stock or index over time, and if the market drops suddenly, it doesn't experience that drop. What does that look like? Of course, everybody out there knows that we're talking pretty much about equity indexed annuities, any kind of equity indexing strategy. How about the third one? Well, the third one is what we've been talking about over the last 7 lessons, and what I'm talking about here today. It's some sort of an overlay onto this safer money that will provide a better rate of return potential and also allow you to design your risk into it, whatever kind of risk you want. So we use options to make that happen. So that's what that line represents. We believe that this sort of portfolio with the proper mix here, and even some of this sort of investments, is the best kind of strategy out there. Now, compare and contrast 2 opportunities. Today, many people out there will just go buy a stock or a mutual fund or an index or an ETF. That's that's what they're being pitched as the best way to go, and they typically look at that over historical references. They say this stock or index has done great over the last 10 years. It's averaging 10%, therefore I'll buy it. That's my decision. That's how I make my decision. Well, of course, if we buy XYZ and the stock, the market, the stock, everything goes up, we're happy, right? That's a huge win for us. What happens if the market is flat? How does that look? I would propose to you that that's a loser. And the reason is, it's twofold. One reason is that if I have my money in something that's flat, what continues to eat away at my assets? Of course, inflation does. So I'm better off moving my money into a CD or money market that gives me a fixed rate of return. Flat means I have a huge opportunity cost where I've got my money someplace that's earning nothing and I could have been earning more. Secondly, if I'm in a mutual fund, for example, or other types of similar investments, I could be paying fees for that. And so if I'm paying fees and I'm not getting any return, the actual real bottom line return could be less than zero. It could be negative. So that's a loser. I also believe that, and I don't think any of you will argue with me, that if the market is going down or the index is going down, that's a loser as well. Now, look at the alternative that we've been talking about over the last several lessons. Optioning XYZ. If I were to do something simple like sell a put against XYZ, I might be paid money, or I will be paid money up front for that. And what I'm hoping for, if you can remember, is a bullish to neutral return on that XYZ over the next, say I'm doing an option contract for a month, I'm hoping for the month it stays flat or goes up a little bit. So what if it goes up? That's a win. I know exactly what I'm going to win. What if it stays flat? If the stock stays flat when I started the contract, that's a huge win as well. I get to keep the premium that was paid to me up front. What if the stock goes down though? What if it goes down? What happens then? Well, if it doesn't go down too much below the original strike price that I bought into, I actually can win here as well. Therein lies the beauty of this whole strategy. I am allowed to win in more ways than if I just go out and buy equities. And so what we're going to talk about over the next several lessons are some real life strategies that Jeff uses for us and our clients every day. And what that's going to do is show us what kind of trades he looks for. It's going to show us what kind of returns he looks for, what periods of time he's shooting for, what kind of risk can be designed into a portfolio. All that. So what you're going to see coming up is very exciting. It's going to put it all into perspective and get you even more fired up about what we're doing. I'm Dan Hunt with Redhawk. If you need to reach us anytime, we're at 952-943-3999. Have a great day.